Thank you guys so much for coming. Really appreciate seeing everybody here. I was mentioning this a couple of people on. This is, I think, Investor Forum number 26. So we've been doing this for quite some time now, and just really appreciate everyone's support for showing up and creating the real estate community that we have here. I prepared a little bit differently for this presentation, and of course, we've all been hearing about ChatGPT and AI, so I spent some time going through that. And I'll give a couple of disclaimers. When I say I, for the next 45 minutes, it has anything to do with planning. What I mean is Cassie. And when I say I with anything to do with technology, it means JD, because I did none of it. And when I say I with anything with the team's performance and track record, that's all Jerry. So I'm just going to say I take credit for all of those things. But I took the last 3 years of our market research and I plugged it in and said, like, what are the themes? Like, you know, what's on people's minds? So starting this one a little bit differently, from the data we've produced, the comments that we've put into our research, there's a couple of themes about what's going on in the marketplace that kept coming up. One is just valuations. People are concerned about what's happening with valuations. Two, what's happening with supply waves, what's going on in the marketplace. Population demand shifts, where are drivers both in state and out of state, regionally, nationally. What's going on with public safety is a big concern. Insurance costs, it used to be taxes, but now we're looking at insurance. You know, overall operating costs, like what's happening with OPEX versus EGI is something we're all watching. And finally, rent control, regulatory risk. And this is the themes from our research for the past several years of what's been coming up. So I thought to just engage everyone a little bit, we do a quick audience poll and see what you guys are thinking about. So this first one, I ask you just vote once, I'll bring all 4 categories. And the question is, what's most on your mind? I know it's hard to distill down, but I'm trying to get a sense of our community, who we serve, what's on your mind. So what are local market concerns of people in this room? Number 1, capital markets, what's going on with that, interest rates. 2, tech layoffs, hiring, what's going on in the job market. 3, Seattle. We have a new mayor, apparently. Is anyone from the mayor's office in here? I invited them. Yeah, right. In here. I did talk to the deputy mayor's office. He may be speaking at our next event, so he's up for it. We might have some Q&A there coming up. A little forecast of what's to come. And the last one is just regulatory risk. This is more Washington nationally, or Washington state versus the nation. So show of hands, vote once. Number 1, capital markets. Who's most concerned about capital markets right now? All right. People like their values? Maybe not, maybe it's bigger. Tech layoffs, hiring. Demand drivers, maybe 20% of the room. Seattle political landscape, maybe 30% of the room. And finally, just overall regulatory risk. Okay. So it seems like demand drivers and what's happening in our local market. The next poll I wanted to do is I wanted to see how people are voting themselves. And when I mean voting, I meant with their investment dollars. So this is you personally, show of hands. We won't share this with anyone else. First poll, who here, by raise a hand, is reallocating capital out of state or considering reallocating capital based upon the aforementioned concerns?
You've been doing it for years.
That's awesome. That's not a lot. And I think that's going to highlight what we're going to discuss today, is we have a lot of conviction in this market. And I realized putting this slide deck together, I'm like, wow, this is a lot of concerns, Dylan. Aren't you a salesperson? Like, what's going on? We're really starting with all these concerns, but we have a lot of conviction with what's to come in this market. The next one, maybe more personal question, who has, is, or is considering changing domicile out of the state of Washington? So a few people. In my daughter's school, we're hearing more about it. It's a real headline concern, and we're seeing that in the market. What I feel good about with these polls is people are voting to participate in this market and stay in this city and this state. So that feels really good. So agenda first is regional overview, just talking about what we're seeing in the region. Second is just some sub-market comparison, what's going on in the markets. Taking a little bit of themes that we're seeing in this market. And then finally, some predictions what we think we're going to have in the market in the near term. Starting right off, regional overview. There's been an arc of what's been going on. A lot of the data that I've pulled for this presentation, it's a completely different format from the years prior, is what's happened the last couple of years to try to see where we're at. And the reason I'm looking at 2023 forward is we had the COVID, big shock to the market. We haven't seen anything like that in a while. And then we had really, really low interest rates with quantitative easing. And that really disrupted the market from what was a low demand in the core and urban markets in COVID to a very high demand, essentially free capital, what felt like it in 22. So the story arc in early 23, we were really still dealing with the supply, the shocks with what was going on with interest rates. Sharp rise, 300 bips, we've not seen that in 40 years. And so we were really in early 23, bringing back, maybe some long memories or bad ones of what was happening in the market, created a huge bid-ask spread. At that peak, we measured this, and I'd say we were 20 to 30% off on valuations in the bid-ask spread. It was severe. It was really, really wide, and that stymied a lot of transactions. We'll look at that moving forward. And then by late 24, we hit peak deliveries. And what happened is we had a glut of developments get capitalized in 21 and 22 because the dynamics of the market, we had a surge of rent growth post-COVID, and we had a lot of capital infused in the market. Fast forward 24 to 30 months, we have deliveries, and then we had this demand imbalance. And based upon the rising interest rate demand imbalance, it was very hard to deploy capital. Take that to late 25, so 18 to 20 months later, and what we started to see is volume normalization. We're going to talk about that today because I think that's one of the biggest trends we've seen in the market is transaction volume normalization. But at the same time, we hit peak vacancy. And again, we've had this imbalance. So early 26 taking us to present, this is a bit of a forecast what we're seeing in the market. One is pricing clarity. I think that bid-ask spread is now within 10%. It's certainly not to a healthy market within 5% where most clears the market. We're probably still seeing maybe 50 to 60% of sales clear the market right now. And before, I'd say in 2023, it was maybe 25%. So we're seeing sales clear the market. We're getting pricing clarity where we can make a market. And we're also seeing that demand normalization, supply versus new inventory, or new inventory versus demand from renters. So the arc of the story has really continued on. And I think we're really getting to a point of clarity for the sake of investing. Now, looking at Puget Sound region as a whole, average rents are above $2,000. I think that's good. We're well above pre-peak levels. We look at this, relative to the Bay Area. Bay Area was 4,000 a unit pre-COVID. They're now just getting back to that. We're still half of their rent levels. They haven't hit 4,000. They're about 3,700 to 3,900, so they're coming back to pre-COVID levels. But we're at peak vacancy 7.4%. Now the headline number, I'm going to lead on this a lot, $6 billion of transaction volume. That's a huge number for this region. We'll show in a bit, but in 2023 it was $2.5 billion. So we've had a huge surge, and I know we see about all these transactions that don't pencil, don't make sense. People are finding a way to get deals done, which is that next metric in the bottom corner is 300 transactions last year. We'll look at some of the data from previous years, but we're back to pricing clarity and transactions clearing the market. Now, average cap rate's 5.4%. This is the highest they've been in a number of years, really since last cycle when cap rates steadily have gone down into the 5 cap range. So we're seeing a peak in cap rates where we're getting deals done. The last one, 380,000 units. I looked back from the first presentation I gave, and the data we went back to in 2012, regional inventory was about 250,000 units. So when you think about that, we've added 130,000 units to a base of 250,000. So we've seen supply grow nearly 50% in the last 13 or 14 years. So that's a huge amount of deliveries coming to this market, still a healthy market. Now, if we look at our 3-year scorecard, and what we're looking at here is just headline numbers, what's been going on. And if you look at rental rates, we're above 2,000, it's stable. They were higher in 24 versus 26, but these are end of 25 numbers. We look at vacancy, it's elevated. We've seen that arc come up. Peak deliveries were a little bit over a year ago, and we're still absorbing them. We look at sales volume, I just mentioned that, we only talked about it a bunch. Sales volume is fantastic. We're definitely seeing strong sales, which means buyers and sellers are coming together. Now, we look at transaction volume, we've talked about that, it's strong. Price per unit, there's a little bit of noise because there's still more urban small units that throw this off. So we counter that with price per net rentable square foot. Both of these are pretty stable. They're not really growing, but the numbers we'll see in a second, they're not that bad. They're just really far off from all these new construction sales. We were seeing stuff at $700 to $1,000 a foot in 21, early 22. So that's come off, but average sales are pretty steady, and then cap rates are elevated. So when we look at that, overall, we're in a stable marketplace. We've got a couple of metrics that are still moving on us before we can really feel like we've got good runway. Back last year, it really felt like 2011, feeling like this year's 2012, where we're picking up from the bottom and moving forward. If we look at the overall regional trend of rents, this is a bit of that arc, is from late 22 to early 24. We've had this new construction wave, but they weren't delivering, and that's why we saw rents steadily grow. Now we've come to this area of peak rental rates where we were above $2,100 a month for regional rental rates, but here we are Q4 2024 peak deliveries. And so this new supply is really having a huge impact on how investors are seeing the market and how operators are being able to operate inside the market. And then finally, we have deliveries are tapering here, but as you see, rent rates are still, they've fallen from the peak and they're still kind of trending down. Now this is data as of Q4, we always know Q4s are soft, but it really shows this cycle that we've been through, but most of what we've seen is behind us there. Now looking at submarket comparison, this is year over year from 23 through the end of last year, what's happening in each of these markets. I'm really excited to see this, is we've finally had this inflection point where Seattle rents are growing year over year. And we just haven't had that. So if you look here, Seattle, each year rents have grown, even though there's still a lot of negative news about what's happening in Seattle, there is still really good positive growth. There are positive trade outs in Seattle. Now, if you look at North King in isolation looks fantastic. We're gonna look at some vacancy numbers in a moment, but there's a lot, that's always been the outlet valve, is the east side's expensive. Think of that like the peninsula in San Francisco. Renters usually push north. And so north has done really well with rental rates, and we'll talk about vacancy in a moment. Now the next one's been an interesting study, is the east side's been a sweetheart market. I've been up here year after year for probably the last 4 years, and we've had falling vacancy, growing rents on the east side, but that glut of new supply has caught up. East side's not going anywhere, like I said, it's kind of like Silicon Valley at this point. It's a T-bill, but this is the first time I've come up here and actually seen rents have declined. Now they've declined 0.5%, so it's pretty nominal, but it's showing this is one of the first times where we've seen the east side not outgrow Seattle. And this is the inflection point I've been talking about for a number of years, is I still think Seattle is underpriced when it comes to rental rates. Now going to South King, South King's been a hard market to underwrite because South King rents grow when people get displaced out of Seattle and Bellevue and they're not as upwardly mobile to go north. So South King's been pretty slow on growth. They haven't had new supply, but it is steadily growing. Snohomish, similar story. We've seen growth up in Snohomish. We have had near-term deliveries in South Snohomish. And then going down to Pierce, if you look at this, and this is why this scale is helpful, Pierce is still really affordable. The average rents in Pierce are still below $1,700. So Pierce is growing, but there's just challenges in that market more from a regulatory perspective. I think it's one of the most undervalued markets in our region, and I'll talk about those opportunities in a moment. And then finally, Kitsap. There's some data I pulled. Kitsap's total inventory is 4% of the region. So there's big swings. You deliver one building in Kitsap, it disrupts the market. So they were over 10% vacancy and it's come down. So their rents are growing. It's been the highest rent growth year over year in the last 3 years, but it's a small market. Now, looking at these markets, I'll run through these. And again, we'll distribute the slide deck probably by early next week, so you don't have to memorize all of these. But if we go through each of these markets, this is cumulative rent growth. And the cumulative rent growth, we'll go through all this, is really strong. Now, when we normalize this with inventory, we get to, for the last 3 years, 4%. So it's nothing to really write home about for 3 years, 4%. But if you break it down into markets, certain markets are starting to grow out of the doldrums of where they were at a couple years ago. And overall, when we weigh this against the amount of new deliveries we've absorbed, the fact that we've had positive rent growth year over year is really a compliment and a testament to the resilience of this market.
Doesn't feel like it.
So this is a rent affordability spectrum. This is a new slide. What I think this really demonstrates is just the deviation in these urban core markets of Seattle and East King, how much rents have surged. The east side rents have gone up, bulk rents the most of anywhere. So we're looking at over $2,500 a unit compared to Pierce County, which is almost $1,000 less. So we're starting to see really big stratification across the market where affordability is going to really come into play. My prognosis is these urban markets aren't going down. I think these urban markets are going to stay high, and I think they're going to get even higher. Inflation's not going away. So when you look at markets like Pierce, there is a value play in that market, and you look at North King, I still think there's a lot of room for these markets to grow, but the spectrum is widening from where it was when we started last cycle. Now, I mentioned vacancy for a bit. This is a graph that's showing vacancy across the region, and what this really demonstrates is it's been rocky. We've had a lot of deliveries, peak deliveries, again, was Q4 of 2024. So we had a lot of deliveries come in. I do think we've hit that peak vacancy number, but for the amount of new deliveries, I think this vacancy would have gone down to historical numbers. Now, one thing, I always put a shout out to Mike Scott and Patty Dupree. When they put out this data, it was normalized against buildings that were in lease-up versus total inventory. So these numbers are generally skewed by, I'd say, 100 to 150 basis points high due to new construction. So I think we are still elevated, but we're certainly seeing these markets come down to some normal periods, and I don't expect to see another spike in what we're seeing with vacancy rates. If we look at this by sub-market, again, Seattle, it's coming down. And I think there's certain markets where we've, Belltown's got some deliveries we've got to get through. Rainier Valley's got some deliveries. There's certain markets where we do have a lot of new supply, but I expect quarter over quarter, Seattle to continue to get stronger. It's already hit peak vacancy. If you look at North King, that's that comment I made a moment ago. Yes, they've had really good rent growth, but it's tempered by all this new supply. And I think this is where investors have had a really challenging time, is underwriting through all of this concessionary environment. I described it to our analyst, or our former analyst, a shout out to Ryder here, who joined Timberland recently. I was sitting with Ryder about 18 months ago and saying, well, it's kind of like underwriting into a marshmallow. It's like, where is the bottom with all these concessions? And that's been the issue in North King, is how we look at all the concessions, where is the bottom? And something I'll bring up again is, I think the number one metric for investors right now is net effective rents. What are actual sustainable rents that you can achieve? And North King's been tough with that. Now, if you look at East King, this slide looks much different. They have a much more elevated vacancy rate right now because of a glut of new supply that's delivered across the spectrum. And the east side really is developing submarkets. So if you look at Redmond, is trading different than Marymore, is trading different than Overlake, trading different than Spring District. So there's stratifications, and now with the upzone in Wilburton, we're starting to see more micro markets, but these markets are competing against themselves. It's new product, it's high quality market, the high quality product. So this market is seeing a lot of new supply. It's not going anywhere. The reason why there's so much new supply is it is probably, if not the best, probably the top 3 markets on the entire West Coast. So that's why the east side has a lot of new supply coming in. You look at South King, vacancy is elevated, but it's really about collection issues. You're getting rid of tenants. You don't want to bring in a new tenant unless you know they're going to be a payer. So there's not a lot of new supply there, but what they're contending with is, how do we operate really well? Snohomish, again, it's had elevated vacancy due to new supply in South Snohomish, but that again is a high quality suburban market. Going down to Pierce, we've had a little bit of elevated vacancy, but the trade-off here is delinquency's gone down. About 3 years ago, we were seeing double-digit delinquency. We're talking 10, 12% collection loss in Pierce County. That's now in control. I'd say great operators are sub 3% collection loss, but they're willing to take a little bit more vacancy risk to get great tenants. And then if you look at Kitsap, this is probably the biggest shift, is Kitsap is absorbing that new supply. So we're starting to see that come in a little bit. Now, turning to capital markets, this is really headline numbers. I think is probably the biggest difference I've seen year over year standing up here is transaction volume. So you look at these early years, 2017, 18 were good years, $4.5 billion. Excise tax change, 2019 we hit 8.2 billion. So that was a really big sales year. We saw a lot of sales that year. 2020, don't need to bring up what happened that year, sales fell off. 2021, interest rates dropped. 3%, 3.25 to 3.75 cap deals across urban markets. Just a different environment, encouraged a lot of sales. We had peak volume. Went back down. 2023, I showed you some of the dynamics. This was that bid-ask spread. So we went from $2.5 billion in 2023 to $8 billion in 2025. So for those of you who've been waiting on the sidelines to get into the market, others have not. People have got into the market. I know it's tough to underwrite transactions and to do deals right now, but the numbers don't lie. We have seen a huge surge in the amount of new transactions come to the market. And the other difference is we're seeing some new market entrants again. We're selling to people out of the Bay Area, Los Angeles, East Coast. So the market has returned. So the question then, number of buildings, we're 400 to 500 sales a year. It dropped off in 23. So again, we've seen the bottom. And if you look at these charts over a long period of time, usually they're not this rocky. Usually they normalize and then they come up. And that's what I expect as we're coming up off the bottom. I don't know if we'll be at 400 transactions this year, but I don't think it's going to drop off. So I think we've seen the bottom. It's beyond us or past us, and we're looking to the future. Now, looking at actual values, this is price per unit. So this is first one, $226 a unit. Pretty low, but this is a mix between old and new product. As you can see, pricing has gone up. We hit a peak of a little over $300,000 a unit in 2021. I think the biggest deal I did in 2021 was $770,000 a unit in Issaquah. That might have broken the market, but we got really, really peaky with price per unit because it was new buildings that were selling and there were larger units, and post-COVID people wanted really big units from the investor base. So it's since come down, but it's coming up off the bottom, and we're starting to see these prices pick up off the bottom because the bid-ask spread's decreasing. I think what's a more salient point is we spend a little bit more time these days looking at price per unit, or price per square foot. And the reason we do that is because there's such a variance in unit size. At any given time, we could be on the market with a building that averages 1,000 square feet per unit and 400 square feet per unit. So there's a big variance. Once you look at these numbers, we were at $237 a square foot back in 2017. If you fast forward, the peak was still under 400. And if you look at the current times, we're at about 340. So if you look at average values, they're still not that far off from a normalized trend. I think the biggest difference is brand new buildings that were trading at sub 4 caps, they were getting really outrageous prices. And I think that's been the challenge that we haven't gotten back to, is that really, really peak pricing. But overall, if you look at capital markets, what we're seeing is a little bit more return to normal. We're seeing pricing come back up a little bit, but I think the biggest thing is investor confidence in the number of transactions, and we'll talk a little bit the average sales price per transaction. Now, capitalization rates drive all of this. This is a tough graph to look at for anyone who did not transact in 21 or 22. It's abnormal to be, averaging throughout the region of 4 cap. That's pretty insane. I'd say throughout the region, we've probably been around a 5 cap market. If you consider those low 4 caps, I'd say the market was about a 4.75 over the last 7 or 8 years. But we're truly at an elevated capitalization rate. Now, there's a lot of reasons for that, and we can look at interest rates, we can look at investor demand, but overall, rarely do we see graphs like this continue going up. And I think we've hit this inflection point given that we're at peak deliveries are behind us, we're at peak vacancy, and all of this time, rents have grown. Back to that chart. Throughout this time, rents have grown. And that shows the resilience of demand in this region. Now, looking at a sub-market comparison, going through each of these markets, what I want to do is provide a little bit of commentary of what we're seeing of how investors are coming at the market and how they're looking at dynamics in each market, how they're looking at pricing in each market, and what's leading to some of these differences in values. I'd say Seattle, taking a step back, rents have gone back up. And comparing this to the east side, it's one of the first times in the last, I'd say, 5 years, 6 years, where Seattle rents have outpaced east side rents. So investors are coming back to this market. We have elevated vacancy, but we've had pretty good year-over-year rent growth across the market. And so from an investment strategy, a lot of investors are taking what's considered a core plus strategy, is they want to buy into this market. What they're looking for is strong recovery story, prices going back up, and they think there's a reversionary analysis here of things coming back to previous peaks, and that's inspiring some confidence. And when they're underwriting this, they're really focusing on new or newer quality assets that are well located. So it's kind of like when the tide goes out, it always comes back, all boats are lifted that's coming in tide, but right now we're seeing the strongest demand for the shiniest, prettiest assets. That still means what falls outside of that is probably still a good value play in Seattle because it's going to trade off those same dynamics. So overall, I think the risk in Seattle is moderate. I think the return potential is one of the strongest ones in the region because we're seeing this reversion. And this is the time in the presentation where I talk about the comparison of San Francisco. The Bay Area in the beginning of 2025, the word I heard was uninvestable. I was at a conference at the beginning of 2025. San Francisco Bay Area, especially San Francisco proper, was probably at a high 5 cap in San Francisco's neighborhoods. By the beginning of 2026, I was at the same conference, and I'd say 50% of the people I talked to were priced out of San Francisco. 12 months, priced out of an entire market. That 5.5, 5.75 cap was down to a mid-4 inside of 12 months. Now the difference in that market, they didn't have a lot of new supply, but the driver in San Francisco was new job creation with AI. Now in San Francisco, they still had more layoffs than they had new jobs. But those layoffs were empty office buildings. The new AI was new office leases. A broker friend of mine was down in the Bay Area recently. There were 80 different tenants looking for office space in the market in the San Francisco Bay Area. So when you look at these dynamics in Seattle, generally we pace about 2 years off the Bay Area. So the reason why I think the return potential is good is if we get this tech hiring up here, this is one of the markets that will take off first. Now looking at North King, I've talked about this before. You look at this elevated vacancy over 10%, and the investment strategy there is we've got to underwrite through all of these concessions. How do we do that? The last couple of buys up there were longer term investors that just said, look, the supply is going to burn off. The new construction numbers don't make sense. New construction assets, the last deal I did there last year, I think replacement cost was a little over $500,000 a door. I represented a buyer, which was a little bit rare, was a 1031. He bought at $330 a door. Now as a low to mid 4 cap, they'll probably get to a 5 cap in the next 24 or 36 months. It's some staying power, but the North King has been really handicapped by all this new supply, and I think it's unfair given the dynamics of that market and the proximity to the east side in Seattle. Again, new supply, most of the renters are getting sucked out of the market with concessions and new product. Very nice, well amenitized new product. And then finally, the value add deals just don't make sense. It's really hard to underwrite to post renovated rents, given the fact that you're a concessionary market with new construction. So I think there's moderate to high near-term risk, but I think overall there's going to be above average returns on the north end. And again, my analogy of the Bay Area, for those of you that know it, I think our north end is the East Bay of San Francisco. I think this is an outlet market for renters to go because they're priced out of the east side, and if you're upwardly mobile, a lot of these people are not going to go immediately south. So I think North King is really I'd say a bit of an unseen gem in the market, but you're going to have to see out a couple of years. Now looking at East King, I think I was a little bit hard on it because I was excited to see Seattle come back up. East King's a T-bill. It's not going anywhere. It is, like I said, my top 3 investment market on the entire West Coast. And I think the thesis there is premium, price to a premium for institutional capital. That shows where investors are placing big bets. Again, we're at an interim plateau. These are expensive rents, but I think considering what's going on with the Meta's doubling down and building out their offices, Amazon's doing the same thing, Microsoft paused on a couple of their new buildings. These are temporary blips. I think the east side is going to continue to accelerate. I think investors think that, and I think they're going to vote with their dollars up there. I think there's pretty low risk. Moderate might be a little bit strong to say risk. I think it's a pretty low risk market. But the return potential, I think a lot of that future growth is priced in. I don't think you're going to go wrong over there. It's just really hard to find assets to buy on this side. Turning to South King. South King has been a really fascinating market because it has been the most transacted market year over year. I've gotten up here, I'd say on average, about 70 different transactions clear the market in South King. The last 2 years, it was under 30. So that market was 50% lower transaction volume. To give by comparison, in Seattle, the average is about 175 transactions a year. Last year was 140. So it's within 10 to 15% of normal. In South King is still probably 40 to 50% off of normal number of transactions. We've got vacancies a bit elevated. We've had pretty tepid rent growth. And so investors want to be paid a return. The average cap rate in South King for 2025 was a 6.3 cap. That's not very exciting for sellers, and that's why sellers are not sellers right now. They are what I call owners. They're not willing to sell at those dynamics. So those deals are tough to come by. And I think that, they didn't get a lot of new supply, so I think we need displacement from the core for South King to be a really viable market, because most owners want to see a low 5 cap to a 5 cap to transact. And I think there's potential for future growth, but we need displacement from the core. So I think there's low to moderate risk in this market. It's just really hard to find an asset to buy, and you're likely buying something at a bit of a premium to current market dynamics, unless there's a forced seller that has to sell into this market. I still think South King's a fantastic market. It's always been our strong, really blue-collar market. I think it's going to continue to grow, but I think the bellwether of growth is going to be up north. Taking a look at Snohomish. Snohomish is pretty similar to South King in so much as it's been a displacement market. Rents are reasonably high. If you look across a region, rents are about $2,000 a unit. We're almost there in Snohomish County. So it's a high quality suburban market, a little bit elevated vacancy. They've had regional, mostly in South King, new supply to contend with. But what investors are looking at, it's a flight to quality. It's a good market, it's good suburban amenities, and investors want to be in that market, and they think there's a good long-term appreciation play to be in Snohomish. I completely agree. I think values are down there. I think they're artificially down because demand hasn't been that high, and we've seen that basically with pretty tepid rent growth. And I think we have localized deliveries in South Snohomish. What I'd say is, again, transaction volume, we're probably about 50% of normal. And part of that is would-be sellers are just not looking to sell into this environment. So I think a lot of the activity has been in these core markets that are heavily traded, but these more suburban markets, there's been less activity. So I think on the horizon, the next 2 to 3 years, we're going to see more trades in these markets. I think now is a chance to get in early on those. It seems expensive, but I think there's still value in those markets. So I think there's low to moderate risk, but I think you're going to get average to above average returns in the long run in the North County. Now turning to Pierce, you look at this number of $1,670 for average rents. That is really low considering the rest of the region and just the proximity to job centers. So we've had elevated vacancy, and this is why it's a yield play. Investors want to get yield. Average cap rate last year was a 6 cap, but this market, Pierce County as a whole, and I'd say peak years, call it 2015 to 2017, there was routinely 100 transactions a year in Pierce County. Right now there's 30 to 40. That market is slowed down immensely because there's a huge bid-ask spread. And so I think investors are looking at saying, if I can get yield, average cap rate's been a 6, I'll go to that market, but there's regulatory risk. There has been a risk with vacancy control and delinquency issues. So investors are having a tough time getting deals done there. I think this is one of those markets where there's still embedded value. It's the cheapest entry point into the region. So people are looking at this as a way to get into the region without paying nosebleed prices. And I think a lot of investors have gone to the southeast and have gone to the middle of the country, and they're just not used to these, what I call dollar cost average pricing that's usually been the metric in this market. And then finally, I say operational excellence. To operate in these markets, you've got to be on top of it. It's very hard to operate in these markets, and you've got a tenant base that a lot of times is not worried about credit score. So those that are operating really well can derive yield, but a lot of market entrants are concerned about that. This is why we've seen a big slowdown. But whenever I see a slowdown, I read that as opportunity. Unless there's some structural issue in the market, which I don't believe at all is the case, I think the investment market's mispricing it. So I think there's moderate risk. I think there is above average return because I think it's just not being captured. I think investors are hesitant to go in this market and they're worried about regulatory risk. Finally, Kitsap, really elevated vacancy. They've had a lot of new supply, but also elevated growth. So Kitsap's been a interesting market to watch just because you've got to be very opportunistic. Like you've got to know that market really well. Silverdale trades much differently than Bremerton. So the players in that market really get to understand the market. Like I said before, it's 4% of regional inventory, about 15,000 units, a little bit less in Kitsap. So I believe investors that know that market well will get rewarded. I think in the near term, there's been some challenges. And so I think there's good long-term growth in Kitsap. There's not a lot of opportunities. So I think it's a market you want to study and get to know. I think there's going to be opportunities there, but there's also people that know that market pretty well. So I think there's moderate to high risk. And I think that high risk is just one new building delivers, cause some challenges, but there's not much on the horizon. I think there's above average returns there. I also think the long-term expansion of this region, it's a high-quality place to live with pretty good public safety, or very good. So I see investors seeing that value proposition. So turning to themes in the market, what we're seeing going on in the market overall, I think the first thing is what I call this rent vacancy paradox. And what I've talked a lot about during this presentation is we've seen really good rent growth, but we've seen it amidst a lot of new supply coming to the market. And I call it a paradox because generally when there's high vacancy, you're not growing rents. And so what we've been able to do is we've been able to grow rents about 7%. At the same time where vacancies moved about 90 basis points, which seems like a lot, but given all the new supply, it's not that much. So I think we're seeing this persistent growth because there's just a structural imbalance, meaning we're undersupplied with housing. And we're, of course, undersupplied with affordable housing. We know that, and there's initiatives out there for it. I just think there is a structural imbalance of supply in this region, and that's why investors came up to this market in droves in the early 2000s and came back in 2012, 13, 14. I think a lot have been scared away because the dynamics that were here 10 years ago that made this a very easy market to invest in 2013 are not here today. There's regulatory risk, there's urban blight, there's the things that all these other urban markets have dealt with, but there's still this structural imbalance. So I think the implication is a lot of groups, most of what I hear in underwriting new assets is how do I deal with concessions? How am I underwriting what true market rents are going to be? How do I underwrite normalized vacancy in a high vacancy market? I think what we're seeing with that is I think that the groups that are going to get through that and look at 3-5 year underwriting, get back to a normalized market are going to win, and I think others are going to miss the market, but it's hard to see through that. So I think as a headline concern, yes, there's a lot to look through to figure out where stabilization is going to be. If you believe in those long-term dynamics, I think you will get rewarded because it is paradoxical that we would have that much rent growth amidst high vacancy. You'd think the market would normalize and both of those would not be going up at the same time. The next one is cap rate arbitrage. Granted what we saw in 2021 was artificially low at 4.1. I think the market is a little bit more close to a 5 cap market, and this includes urban assets on the east side that might be a 4.25 cap to everything in outlying counties that might be a 6. We've just normalized around a 5 cap year over year, and right now we're at this 5.4. So I think investors that are coming in at what I consider elevated cap rates, I don't expect them to continue to expand. I think we've hit a peak. Now what happened is we saw cap rates expand. In 2023 they were 4.9, 2024 they were 5.1, and now they're 5. In 2024 they were 5.1 or 5.3, and now we're 5.4. So that race up to the top is starting to taper, and we saw that in the graph. So I think we're seeing good signs for a good entrance point right now to see through the noise. And granted, yes, we are in a different interest rate environment, and we have demand considerations we've got to get through, and we don't know about tech layoffs. But if you look at overall, we're coming in at a good point, and I think the purchases today are going to benefit from those long-term averages. And really, yes, cap rates trade off of interest rates, and they trade off of current income. I think one of the best definitions of a cap rate is a measure of consumer sentiment. If people believe strongly in an asset, they will drive that cap rate down. Proof, San Francisco. Interest rate environment in 2024 versus 2025, nominally different. Cap rates went down over 100 basis points inside of 1 year. Interest rates didn't go down, rents went up, but the real acceleration in rent was later in 2025. It was investors getting confidence in that market, seeing good trade outs, bidding that cap rate down. So I think that there's been this, what I call a valuation reset, and I think that risk reward is in balance now where maybe it wasn't in 2023, 2024, people were concerned about it. We've seen it in the numbers in 2025. More investors have got essentially comfortable with dollar cost averaging into this market. There's of course great deals out there. There's gonna be some you scratch your head and say how they got this done, but I think overall the market is getting to a point of greater normalization. So what I call this last one is the $6 billion signal. And that signal is institutional capital's return to this market. And so when I was down, there's this big investor conference, NMHC, many of you go to, National Multifamily Housing Council. Don't say that after a couple of drinks down there. So, I don't know, 7,000 people down there. I have never talked about a mayor so much in my life. I have literally, oh, Lori's great in San Francisco. I know the name of every mayor on the entire West Coast because people care about mayors. And what I told people when they asked me like what my concern was, and I'm like, well, she's either gonna shit the bed and be gone in 3 years or be okay and there's no risk. So if you're gonna buy an asset and then sell in the next 2 years, I don't know what to do, but if you're gonna hold, don't worry about it, it's noise. And the response was, I think the concern is directly proportional to the distance from Seattle. The further you get away, the more people are concerned. And I think the advantage of people that are in this room and know this market and feel comfortable in this market is it's noise. And so what we're seeing is more capital coming back to the market. So the average deal size every year over year has gone up 10 to 20%. So I didn't see these dynamics but for 2019 and 2021, which were the most institutional investment markets. Now, I'm not saying you follow the institutions because there's pitfalls with that, but there's greater confidence. What I'll say is there's more robust underwriting with the institutions. There's different thinking. And so what we're seeing is the market starting to clear with greater capital coming into this market. Now, the other risk with that is more capital comes in the market, and we're seeing in the Bay Area, they just bid down cap rates, which bids up price. So to me, it's not necessarily following this money, but it is a signal that this market is getting validated by exterior market entrants, that a big difference from people that are local operators here, those big institutions have choices. And those choices were Florida and Atlanta and Vegas, and they've looked at those other markets and they don't like them. Now, I've seen this in my career 3 times now. People leave this market, chase usually Texas. This cycle it was Florida, and come back to this market, and that's what I'm seeing going on right now. So I think there's a big signal there that more capital is coming to this market, and it's coming to this market for a reason. So a couple predictions of what we think is going to happen. The first one is regional rent forecast. Disclaimer, this isn't axiometrics, it's not Reese, it's not even Green Street, it's just me. And a little bit of ChatGPT, maybe Claude. But when I look at it, I think this year, we go back to 2024, regional rents were $21.34, $21.40. So we're 5% below where we were 18 months ago. And we've added all these units in the last 2 years. We've probably added 25,000 units of supply in the last 2 years with tech layoffs and less jobs, and rents have gone up. Now, in the last little bit, they've gone down across the region. I think we're gonna get back to that level this year. Now, I think the conservative underwriting is 0, and I think we could see 5% rent growth. Now, I think it's gonna be skewed. I think there's markets, it's gonna be hard to grow those rents because of new supply, and I think there's markets that are gonna start to accelerate. I think the year after that, we've got another potential of another 3 to 5%. And it's just, you look at the dynamics of vacancy, you look at what's happening in other markets, and you look at where we've been, and the next slide we'll talk about vacancy tapering just based on deliveries. So I think we're at a point where we're going to start to see growth in this market while vacancy is shrinking. And I think the delivery pipeline, which we'll talk about 2 slides from now, is gonna have a big impact on that. And I think that supply cliff is nigh. I mean, it's not this year, we thought it was gonna be this year, but for the developers in this room, it always takes longer to deliver a building than you think it's going to, and that's what we faced. So I think there's risk. There's absolutely risk coming in the market, because if you look at all those data providers, some wonk in New York, no offense to them, is just looking at this market, and his report's due in another 2 hours, and he's underwriting 80 markets across the US. They say, yeah, Seattle, look at all that new supply. And they're not looking as granular, and they're handicapping it. They're saying, well, I don't want to be wrong, so I'll put it in 1%. And I've seen some data providers go, this was Q4 2024, Bellevue in, I think it was Axiometrics, and Q4 was 8% rent growth projection. Q1 the next year was 1.8. No, it's 8.1. So I think they just transposed the numbers, so that it's went from 8.1 to 1.8. Literally happened. We pulled the data. They don't know what the hell they're talking about. No offense to them, but they're hunting and pecking. So I think the upside is, if we do see tech job growth, we've seen this happen in the Bay Area, we tend to follow them. I think we're on the upper end of this. The next, vacancy forecast. I'd like to say it's super scientific. We just ran the numbers and we looked at new supply and we looked at absorption, and I think we're going to taper back down. And I think we're going to get back down in 2027. I think we're going to get back into the 6s, and if you look at new supply, this is probably in the 5s, and we're probably in a healthy market. And a lot of this is we're getting through this pipeline and we're absorbing it well. We're not seeing rents we're going backwards in a couple of markets or just holding. But like I said, the east side on $2,500 rents, they went back $12 and they added thousands of units. That is really, really strong resilience. And eventually those people are going to get priced out. They're going to go north and they're going to go south, and those markets are going to grow. And so finally, what we call the supply cliff. We've been delivering 10 to 12,000 units a year. It's really hard to get a good number on this, but for just calling every developer and seeing what they delivered. Some data shows that in 2014, we delivered 15,000 units. The biggest delivery year I've counted in the last 13 years was 12,000 units. So in 2024, we delivered somewhere between 12 and 15,000 units, and rent still went up. Nominally, maybe 1%. Vacancy went up, but we've delivered a ton of units. This is going down. It's just math. Developers, and we sell a lot of development land, it takes 24 to 30 months to deliver a building. So unless a crane is in the ground right now, it's probably not leasing up for 18 to 20 months. So we can look at these numbers and we can look ahead. Now, what's happening that is new this year that wasn't here last year is the east side, there's new deals getting funded. And just to give you a concept of what we're seeing on that, is pricing is probably 400 to 500,000 a unit, depending where you are. New construction is probably 400 to 500,000 a unit. So developers are building to what the value is today, because they believe in the future. And that's happening on the east side right now. So we are seeing a new development pipeline pick up on the east side, a little bit less so in Seattle. But this cliff is happening, and we've got leading indicators on it. And I think we're going back to an environment in the next 24 to 36 months, which we haven't seen, this decade. So I think there's an opportunity there. Factors to watch, just what we're paying attention to in the market. Number one, Fed rate decisions. We've got 7 more meetings this year of FOMC. We've got one next week, 25 to 50 bips. We could be at 3.5 by the end of the year. See how many more wars we start. There's a lot of noise out there. We don't know. I'm trying to encourage people to read history books, not headlines. So you look at the factors that provide resilience to this market, but this is going to drive investor behavior. Tech sector employment, downside risk, it just doesn't happen. I'm not saying I have special insights, but I know a lot of people in the Bay Area. I am friends with one of the chief AI officers from Microsoft, and they're spending it, and they're getting to the point to grow and hire. And Bay Area companies are, like Anthropic, are buying Seattle companies. This is that virtuous cycle that started in 2013, 2014, 10 years ago. And that's why I feel like it very much feels like that 2012, 2013 period. And all those people that didn't buy then by 2016 wish they had. Construction permits, this is that next cycle, that next wave that's coming up. It's pretty localized, but we're paying attention. I think North King absorption is going to be really telling. Because the more they absorb, that means more people are getting displaced out of Seattle and getting displaced out of Bellevue due to pricing. So if they're moving north, what's going to happen next is they're moving south, and we're going to start to see rents grow. And once we start seeing 6% rent growth trade outs in South King, those deals that need 5.5 cap deals are going to become 4.9 deals, and pricing's going to take off, and that's what happened last cycle around 2014, 2015 after we had growth in the core. Again, looking at these long-term cycles. Legislative taxation, it's a big deal. Show of hands of friend groups, friend cohorts. I know a decent number of people that are looking to change domiciles. These are tech founders, these are guys that own their companies, they're planning an exit in the next 5 years, they don't want to pay the tax. So I don't need to get into the politics of it, but it's bad policy. So we've just got to watch it. It's something to pay attention to. And then the last one is competition and concessions. This is where all underwriting falls to right now. It's like underwriting into that marshmallow. It's like, where do I believe net effective rents are, and how do I buy this building today? And I think if you apply today's rents and flat to nominal rent growth, you're not a buyer. So I think you're getting to that point, you have to have conviction in the future. And if you do today, my thesis is you'll be rewarded tomorrow. Thank you to the whole team. I really couldn't be up here doing this if I wasn't supported by everyone on the team. So special thanks to Cassie for getting this all put together very seamlessly. Thank you for being my Claude technician and consultant, and really the whole team. We've had a really great 2025. We really enjoy having you guys as a community. I finished up a little bit early this time. Just want to open the floor. We've got 5 to 7 minutes for any questions.
Fascinating to hear at the beginning of the presentation about 50% inventory growth in the region. And at the end, we're still talking about structural undersupply.
Yep.
So I agree with that. Where of the submarkets that you covered do you think we're most structurally undersupplied?
It's a great question. I think there's going to be select neighborhoods in Seattle that just didn't get new supply. And I think a great one that I look at is Capitol Hill. Capitol Hill's at one crane. I don't see Manheim in the room or TJ, but I looked at the pipeline of Capitol Hill, 139 units. That's one building on Capitol Hill. So I think you've got to be, I can't give you like a market, because generally if it's a good market, investors are going there. They knew about it. So I think the north end is a great market, but I don't think we're necessarily undersupplied right now because a lot of delivery came there. Same with the east side. So I do think there's going to be select urban markets that didn't get new supply. And Garden Court, if you can find any Garden Court deals, there's not many out there, but I think it's got to be a pretty granular analysis. And I think COVID, Chop Chaz was the reason for that. West Seattle is another market I think is going to have some structural due to the bridge going down and what was going on at that time. Yeah.
So the light rail opens up 3 years late here at the end of the month. Are you guys thinking it might happen in kind of a trade market effect between East Side and Seattle? Have you thought about it?
Yeah, I mean, I thought deeply about it. I mean, you've probably heard me make a lot of comparisons to the Bay Area. But in a previous life, I was a technology attorney living in Silicon Valley, but I wanted to wake up in San Francisco. So one of my first theses is the importance of Saturday morning back to Capitol Hill. I think there's a lot of renters that want to wake up on Capitol Hill but work on the east side. So when I go home every day, yes, I defected to the east side, pick on me at will, but I still believe in Seattle. I think young people want to live here. So I'm seeing that train cross the bridge now testing. So just like BART, it took BART a long time to catch hold. I do think the traffic patterns, I'm talking to more people stuck in traffic in the morning. So I think, again, this is the map to the Silicon Valley to San Francisco. So I think once that opens, in the next 12 to 24 months, we're going to start to see those markets trading off each other. Nothing against Ballard. I think Ballard's an incredible market, but you're not going to work at Microsoft and live in Ballard. You're going to live in Capitol Hill. You're going to live in, you live in, I think even in the Rainier Valley, there's going to be people who are going to want to get to the east side. So I think that's going to have an impact. I think these are always delayed, but when they happen, they accelerate quicker than we expect. Yeah.
So in your conversations with San Francisco people, my concern with all the taxes we're increasing is not that people are going to move to Texas, but now that we're taxing as heavily as California and San Francisco, and they're going to want to live in San Francisco and start their taxes in San Francisco.
Yep.
Instead.
Great question. Yeah, I have a personal friend and client, and he's like, all things considered, my family's in California, maybe I can go back. He's not a tech founder. I think there's two reasons technology companies come up here. I think one, they're a Goliath, and they need more talent. And so you take an Anthropic, it's all the reason Apple came up here and everyone else. You just need more headcount, you need more engineers, you have to be up here. And number two is you can't compete in the Bay Area. Yes, that founder's getting taxed, but now his employees, instead of paying $2,000 rents, they gotta pay $4,000 rents. So I'm a Californian, don't hold it against me, I say it takes 30 years to be a local, so I'm halfway there, guys. But I look at the challenge of living in California, it's fantastic. And if you are, if you've got a trust fund, move to the west side of LA or Miami, that's great. But I think there are structural factors that, despite those taxes, keep people up here. And I don't think it's great, I don't support the policy, but I do think economic growth will go through that. If you look at, if you look at the politics that we're bringing here, this started in the Bay Area in the 80s, late 70s and 80s. It happened in New York before that, and they've outgrown it. So I think economics will outgrow bad policy. I think bad policy is going to stymie how much we grow. So I don't think it's that much of a headline concern at the top. I think it's more the middle, do we keep the engineers here? Yeah, of course. Well, that's it. Thank you guys so much. I really appreciate the support. Thanks to the whole team, and wish you guys all a great spring. Thank you.